Market Psychology and Sentiment Analysis in Cryptocurrency Markets. Introduction. The human element of trading. Cryptocurrency markets are more than just charts, numbers, and technical indicators. At their core, they are driven by human emotions, collective behaviors, and psychological patterns that can dramatically influence price movements. Understanding market psychology is not just an academic exercise, it's a critical skill for any serious crypto trader seeking to navigate the complex and often irrational world of digital asset trading. Understanding market cycles. Market cycles are predictable patterns of human behavior that repeat across various financial markets, with cryptocurrency markets exhibiting these patterns with remarkable intensity and compressed timelines. The 4 stages of market cycles. 1. Accumulation phase. Market bottom after a prolonged downtrend. Smart money and contrarian investors begin buying. Low public interest and widespread pessimism. Prices remain relatively stable with minimal volatility. 2. Markup, uptrend, phase. Prices begin to rise. Increasing market participation. Growing media attention. Momentum traders enter the market. FOMO, fear of missing out, starts to build. 3. Distribution phase. Market reaches peak excitement. Parabolic price increases. Widespread public speculation. Early investors begin selling. Market sentiment becomes euphoric. 4. Markdown, downtrend, phase. Price corrections and potential crash. Panic selling. Loss of market confidence. Capitulation of late entrants. Return to accumulation phase. Bull and bear market dynamics. Bull market characteristics. Sustained price increases. Positive market sentiment. High trading volumes. Increased media coverage. Rapid project and token launches. Investor optimism. Bear market characteristics. Prolonged price declines. Negative market sentiment. Reduced trading volumes. Project failures and consolidations. Investor pessimism. Flight to perceived safer assets. Fear and Greed Index. The Fear and Greed Index is a critical tool for understanding market sentiment, typically measured on a scale from 0, extreme fear, to 100, extreme greed. Sentiment zones. 0 to 20, extreme fear. Potential buying opportunity. Market likely oversold. High pessimism. 20 to 40, fear. Cautious market sentiment. Potential trend reversal signals. Reduced market participation. 40 to 60, neutral. Balanced market conditions. Uncertain directional momentum. Potential consolidation period. 60 to 80, greed. Increasing market optimism. Rising prices. Potential overvaluation risks. 80 to 100, extreme greed. Market euphoria. High risk of bubble formation. Potential imminent correction. Calculating sentiment. Sentiment indices typically aggregate multiple factors. Volatility. Market momentum. Social media mentions. Google search trends. Put-call ratios. Market dominance. Reading market sentiment. Tools and techniques. 1. Social media analysis. Twitter sentiment tracking. Reddit community discussions. Telegram and Discord group insights. 2. On-chain metrics. Transaction volumes. Active wallet addresses. Network growth. Token concentration. 3. Google Trends. Search volume for crypto-related terms. Interest in specific cryptocurrencies. Global search patterns. 4. Sentiment aggregation platforms. Cryptofear.com. The Thai. Lunar Crush. Sentiment tracking websites. Contrarian trading approaches. Contrarian trading involves taking positions opposite to the prevailing market sentiment, based on the premise that crowds are often wrong at market extremes. Contrarian strategy principles. Buy when others are fearful. Sell when others are greedy. Challenge mainstream narratives. Maintain independent analysis. Use sentiment as a potential reversal indicator. Risk management in contrarian trading. Never commit entire portfolio. Use strict stop-loss strategies. Maintain diversification. Combine sentiment analysis with technical analysis. Avoid absolute contrarianism. Behavioral economics in crypto. Cognitive biases affecting crypto trading. 1. Confirmation bias. Seeking information that confirms existing beliefs. Ignoring contradictory evidence. Solution: actively seek diverse perspectives. 2. Herd mentality. Following crowd behavior. FOMO-driven investments. Solution: independent research and critical thinking. 3. Anchoring bias. Fixating on initial price points. Difficulty adjusting to new information. Solution: dynamic strategy adaptation. 4. Sunk cost fallacy. Holding losing positions due to previous investment. Emotional attachment to investments. Solution: objective position evaluation. Conclusion: market psychology is a nuanced and complex field in cryptocurrency trading. Success comes from understanding not just market mechanics, but the human emotions driving those mechanics. Traders who can master their own psychology and objectively analyze market sentiment will have a significant competitive advantage. Key takeaways: markets are driven by human emotions. Sentiment is a powerful but not infallible indicator. Maintain emotional discipline. Continuously learn and adapt. Use sentiment as one of multiple analysis tools. Chapter 12: Navigating the Global Cryptocurrency Regulatory Landscape. Introduction: the evolving regulatory environment. Cryptocurrency regulation represents one of the most dynamic and complex legal landscapes in modern financial history. As digital assets continue to challenge traditional financial systems, governments and regulatory bodies worldwide are constantly adapting their approaches to oversight, taxation, and legal classification. Global cryptocurrency regulations, a comparative overview. Regulatory approaches by region. United States. Regulatory bodies. Securities and Exchange Commission, SEC. Commodity Futures Trading Commission, CFTC. Internal Revenue Service, IRS. Key characteristics: stringent securities regulations, aggressive enforcement actions, ongoing debate about crypto asset classification. State-level regulations vary significantly. European Union. Comprehensive regulatory framework. Markets in crypto assets, MiCA, regulation. Unified approach across member states. Focus on consumer protection. Anti-money laundering, AML, compliance. Asia-Pacific region. Diverse regulatory landscape. Japan. Progressive, structured regulation. China. Strict restrictions on crypto trading. Singapore. Supportive, well-defined regulatory environment. South Korea. Increasing regulatory oversight. Switzerland. Crypto Valley. Blockchain-friendly regulatory approach. Clear legal framework for crypto businesses. Attractive jurisdiction for crypto startups. Tax implications of cryptocurrency trading. Classification of crypto assets. Property. Capital asset. Commodity. Income generating asset. Taxable events. 1. Selling cryptocurrency for fiat currency. 2. Trading one cryptocurrency for another. 3. Using crypto to purchase goods or services. 4. Receiving crypto as income or payment. 5. Mining cryptocurrency. Tax reporting requirements. United States tax reporting. IRS Form 8949, Capital Gains and Losses. Schedule D. Capital Gains and Losses. Form 1040, Reporting Crypto Income. FBAR and FATCA reporting for foreign exchanges. Compliance strategies for crypto traders. Risk mitigation approaches. 1. Maintain detailed records. Complete transaction history. Purchase prices. Sale prices. Exchange records. Wallet addresses. 2. Use professional tools. Crypto tax software. Accounting platforms. Portfolio tracking applications. 3. Understand local regulations. Consult local tax professionals. Stay updated on regulatory changes. Attend crypto regulatory workshops. Emerging regulatory trends. Key developments. Increased KYC, AML requirements. Institutional cryptocurrency adoption. Central bank digital currencies, CBDCs. Global taxation coordination. Enhanced reporting standards. Future regulatory outlook. Growing regulatory clarity. Increased institutional involvement. Standardization of crypto asset classification. Enhanced consumer protection mechanisms. Legal considerations for traders. Critical legal considerations. 1. Jurisdiction-specific regulations. 2. Tax compliance. 3. Anti-money laundering laws. 4. Securities regulations. 5. Reporting requirements. Risk management checklist. Understand local crypto regulations. Maintain comprehensive transaction records. Use compliant exchanges. Report all taxable events. Consult with tax and legal professionals. Stay informed about regulatory changes. Conclusion. The cryptocurrency regulatory landscape is complex and continuously evolving. Successful traders must remain adaptable, informed, and proactive in understanding and complying with regulatory requirements. Key takeaways. Regulations vary significantly by jurisdiction. Comprehensive record keeping is crucial. Stay informed about legal developments. Prioritize compliance and risk management. Seek professional advice when necessary. Recommended resources. Local tax authority websites. Crypto regulatory forums. Professional legal and tax consultations. Regulatory update newsletters. Blockchain policy research centers. Chapter 13. Non-fungible tokens, NFTs, and crypto investments. Introduction. The NFT revolution. Non-fungible tokens, NFTs, represent a groundbreaking intersection of blockchain technology, digital ownership, and creative expression. Unlike traditional cryptocurrencies, each NFT is a unique digital asset with distinct characteristics, ownership, and potential value. This chapter explores the complex world of NFTs, their investment potential, and the transformative impact on digital ownership. Understanding non-fungible tokens, NFTs. What are NFTs? Non-fungible tokens are cryptographic assets stored on a blockchain that represent ownership of a unique item or piece of content. Key characteristics include uniqueness. Each token is distinct and cannot be exchanged on a like-for-like basis. Indivisibility. Cannot be divided into smaller units. Verifiable ownership. Blockchain provides transparent ownership history. Programmability. Can include smart contract functionality. Technical foundation. NFTs typically rely on blockchain standards. Ethereum ERC-721, first standard for non-fungible tokens. ERC-1155, multi-token standard allowing both fungible and non-fungible tokens. Solana NFT standard, alternative blockchain for NFT creation. NFT marketplaces. Leading NFT platforms. 1. OpenSea. Largest NFT marketplace. Supports multiple blockchain networks. Wide variety of digital assets. 2. Rarible. Community-owned marketplace. Allows direct creator minting. Governance token for platform participants. 3. Magic Eden. Solana-based NFT marketplace. Low transaction fees. Strong focus on digital collectibles. 4. Nifty Gateway. Curated NFT platform. Focus on high-end digital art. Owned by Gemini Cryptocurrency Exchange. Investment strategies for NFTs. Diversification approaches. 1. Blue chip NFT collections. CryptoPunks. Bored Ape Yacht Club. Art blocks. Established projects with proven track record. 2. Emerging artist collections. Up-and-coming digital artists. Lower entry price. Potential for significant appreciation. 3. Utility-based NFTs. Gaming assets. Metaverse land. Functional tokens with practical use cases. Risk management strategies. Limit NFT investments to 5 to 10% of crypto portfolio. Conduct thorough due diligence. Understand project fundamentals. Assess creator reputation. Monitor market trends. Digital art and collectibles. Categories of NFT collectibles. 1. Digital art. Original digital artwork. Limited edition releases. Verified authenticity. 2. Profile picture (PFP) collections. Generative art collections. Social signaling. Community membership. 3. Gaming NFTs. In-game assets. Character skins. Virtual real estate. 4. Music and entertainment. Exclusive audio, video content. Concert tickets. Artist memorabilia. Investment valuation metrics. NFT valuation considerations. Rarity. Creator reputation. Historical sales. Community engagement. Utility. Aesthetic appeal. Future of the NFT ecosystem. Emerging trends. 1. Fractional NFT ownership. Democratizing high-value assets. Allowing partial investment. 2. NFT integration. Metaverse applications. Gaming ecosystems. Digital identity. 3. Real-world asset tokenization. Real estate. Intellectual property. Luxury goods. Potential challenges. Regulatory uncertainty. Market volatility. Technological scalability. Environmental concerns. Conclusion. NFTs represent a revolutionary approach to digital ownership, blending technology, art, and investment. Success requires deep understanding, strategic approach, and continuous learning. Key investment principles. Research thoroughly. Diversify carefully. Understand underlying value. Stay informed about technological developments. Manage risk proactively. Recommended research sources. NFT-focused research platforms. Blockchain art galleries. Crypto investment forums. Digital art communities. Technological innovation reports. Warning and disclaimer. NFT investments carry significant risks. Potential investors should conduct independent research. Only invest what they can afford to lose. Understand the speculative nature of the market. Seek professional financial advice. Chapter 14. The Future of Cryptocurrency, Navigating the Next Frontier. Introduction. A transformative financial horizon. Cryptocurrency is no longer a fringe technology or speculative experiment. It represents a fundamental reimagining of financial systems, value transfer, and digital economics. As we stand at the cusp of a technological revolution, understanding the potential trajectories of cryptocurrencies becomes crucial for investors, technologists, and global economic participants. Emerging cryptocurrency trends. Technological convergence. 1. Blockchain beyond currency. Decentralized applications, dApps. Smart contract ecosystems. Blockchain in supply chain, healthcare, and governance. 2. Interoperability protocols. Cross-chain communication. Multi-blockchain networks. Seamless asset transfer between different blockchain infrastructures. 3. Web 3.0 integration. Decentralized internet infrastructure. User-owned digital identities. Tokenized economic models. Institutional adoption. Corporate investment strategies. 1. Treasury diversification. Bitcoin as corporate reserve asset. Hedge against inflation. Alternative investment strategy. 2. Financial product development. Cryptocurrency ETFs. Crypto-backed financial instruments. Derivative products. 3. Blockchain infrastructure investment. Enterprise blockchain solutions. Private blockchain networks. Technological infrastructure development. Institutional adoption metrics. Total corporate Bitcoin holdings. Cryptocurrency investment by major financial institutions. Development of crypto-related financial products. Regulatory framework evolution. Technological innovations. Advanced blockchain concepts. 1. Quantum-resistant cryptography. Protection against quantum computing threats. Enhanced security protocols. Next-generation encryption methods. 2. Layer 2 scaling solutions. Lightning Network. Polygon. Optimistic rollups. Improved transaction speed and efficiency. 3. Sustainable consensus mechanisms. Proof of stake (POS). Energy-efficient validation. Reduced environmental impact. Potential market transformations. Paradigm shifts. 1. Decentralized finance (DeFi). Disintermediation of financial services. Permissionless lending and borrowing. Global financial inclusion. 2. Central bank digital currencies (CBDCs). Government-backed digital currencies. Programmable money. Enhanced monetary policy tools. 3. Global payment restructuring. Faster cross-border transactions. Reduced transaction costs. Elimination of intermediaries. Long-term investment perspectives. Strategic investment considerations. 1. Portfolio allocation. Cryptocurrency as alternative asset class. Diversification strategy. Risk management approaches. 2. Generational wealth transfer. Digital asset inheritance. New wealth generation models. Technological investment paradigms. 3. Global economic implications. Potential disruption of traditional banking. Alternative economic systems. Democratization of financial access. Conclusion. Navigating uncertainty with vision. The future of cryptocurrency is not a predetermined path but a landscape of immense potential and complexity. Success will belong to those who combine technological understanding, strategic thinking, and adaptable investment approaches. Key future-oriented principles. Continuous learning. Technological curiosity. Risk-aware investment. Global perspective. Ethical technological development. Recommended future-focused resources. Blockchain research institutions. Cryptocurrency innovation labs. Technological foresight publications. Global economic trend analysis. Interdisciplinary technology conferences. Final caution. Cryptocurrency represents a revolutionary but volatile technological and economic domain. Always. Conduct independent research. Understand inherent risks. Invest responsibly. Maintain a long-term perspective. Seek diverse expert opinions. Chapter 3. Market Structure and Composition. 3.1 Market Segmentation and Asset Categories. The cryptocurrency market has evolved from Bitcoin alone to encompass diverse asset categories with distinct characteristics, use cases, and market dynamics. Major segments include monetary cryptocurrencies, designed primarily as mediums of exchange, stores of value, or units of account. Bitcoin, BTC, the original cryptocurrency, positioning as digital gold and settlement layer. Litecoin, LTC, earlier altcoin focused on faster and cheaper transactions. Bitcoin Cash, BCH, fork emphasizing payment functionality through larger blocks. Monero, XMR, privacy-focused monetary system with fungible units. Smart contract platforms, providing programmable infrastructure for decentralized applications. Ethereum, pioneer of smart contract functionality. Solana, Sol, high-performance platform optimized for scalability. Cardano, ADA, research-driven approach with formal verification. Avalanche, AVAX, subnet architecture allowing customizable blockchains. Stablecoins, cryptocurrencies designed to maintain stable value, typically pegged to fiat currencies. Fiat collateralized, USDT, Tether, USDC, USD Coin, BUSD, Binance USD. Crypto collateralized, DAI, MakerDAO, LUSD, Liquidity. Algorithmic, partially or fully algorithm-based stability mechanisms. Utility tokens, used to access specific protocol functions or services. Exchange tokens, BNB, Binance, Crow, Crypto.com. Service tokens, Link, Chainlink, GRT, The Graph. Governance tokens, Uni, Uniswap, Comp, Compound. Privacy coins, focused on providing enhanced transaction privacy. Zcash, ZEC, optional privacy through zero-knowledge proofs. Dash, private send feature for anonymized transactions. Non-fungible tokens, NFTs, unique digital assets representing ownership of specific items. Art collections, CryptoPunks, Bored Ape Yacht Club. Gaming assets, Axie Infinity, The Sandbox. Domain names, Ethereum Name Service, ENS. Decentralized finance, DeFi, tokens, supporting financial services without centralized intermediaries. Lending protocols, AAVE, Comp. Decentralized exchanges, Uni, Sushi. Derivatives, SNX, DYDX. Infrastructure tokens, supporting blockchain interoperability and services. Oracle networks, Link, Band. Interoperability protocols, Atom. Scaling solutions, Matic, Op. Market capitalization distribution across these segments has shifted over time. Bitcoin dominated with over 90% of total market capitalization in its early years, but its market dominance has fluctuated, typically ranging between 40 to 60% in recent years as the ecosystem has diversified. 3.2 Exchange ecosystems and trading venues. The cryptocurrency market operates across various trading venues, each with distinct characteristics affecting market dynamics. Centralized exchanges, CEXs, operated by companies that facilitate trading through order matching systems. Tier 1 global exchanges, Binance, Coinbase, Kraken. Regional leaders, Bitfinex, Europe, Bithumb, Korea, Huobi, Asia. Derivatives focused, Deribit, BitMEX, OKX. Institutional-oriented, Gemini, Itbit, Bitstamp. CEXs typically offer higher liquidity and trading volumes. Advanced trading features, margin, futures, options. Fiat on-ramps and offboarding. Custodial services, exchange holds private keys. KYC, AML compliance. Decentralized exchanges, DEXs, protocol-based trading platforms operating without centralized intermediaries. Automated market makers, Uniswap, SushiSwap, PancakeSwap. Order book DEXs, DYDX, Serum. Cross-chain DEXs, Thorchain, Polkadex. Aggregators, 1inch, Matcha. DEXs typically offer non-custodial trading, users maintain private key control. Permissionless listing and trading. Reduced regulatory oversight. Smart contract-based execution. Integration with broader DeFi ecosystems. Over-the-counter, OTC, desks, facilitate large trades directly between parties. Exchange-affiliated, Coinbase Prime, Gemini Prime. Independent, Galaxy Digital, Cumberland, Genesis Trading. Broker-dealers, B2C2, Wintermute. OTC trading provides execution of large orders with minimal market impact. Custom settlement arrangements. Personalized service for high net worth and institutional clients. Block trades for illiquid assets. Derivatives markets, trading contracts based on underlying cryptocurrency assets. Futures, CME, regulated, Binance, Bybit, unregulated. Options, Deribit, Ledgerx, CME. Perpetual swaps, BitMEX, Pioneers, FTX, Binance. Structured products, enhanced yield notes, principal protected notes. The market structure is further shaped by liquidity aggregators, connect trading venues to optimize execution. Dark pools, facilitate anonymous trading of large blocks. Auction mechanisms, used for initial distributions and large trades. Staking platforms, allow yield generation while maintaining liquidity. Trading activity distribution among these venues fluctuates based on market conditions, regulatory developments, and technological advancements. During periods of extreme volatility, Traders often migrate to the most liquid and technically robust platforms, sometimes creating significant price discrepancies between venues. 3.3 Market depth and liquidity characteristics. Liquidity, the ability to execute trades of substantial size without significant price impact, varies dramatically across cryptocurrency markets. Several metrics help quantify market liquidity. Bid-ask spread, the difference between the highest buy, bid, and lowest sell, ask prices. Major cryptocurrencies like Bitcoin and Ethereum typically maintain spreads below 0.1% on leading exchanges. Mid-cap assets might show spreads of 0.5–2%. Small cap or newly listed assets can have spreads exceeding 5%. Market depth, the volume of orders at various price levels away from the current price. Often visualized as a cumulative order book chart. Can be quantified as the cost of moving the market price by a specific percentage. Depth asymmetries, more liquidity on bid versus ask side or vice versa, can signal sentiment. Slippage, the difference between expected execution price and actual execution price. Calculated as execution price, expected price times 100%. Frequently used as a practical measure of effective liquidity. Heavily dependent on order size relative to available liquidity. Volume profile, the distribution of trading volume across price levels over time. Identifies price levels with historically high trading activity. Helps locate liquidity pools where large orders can be absorbed. Often correlates with technical support and resistance levels. Cryptocurrency liquidity exhibits several distinctive patterns. 1. Time-based variations. Market depth typically decreases during Asian and European overnight hours. 2. Venue fragmentation. Liquidity splits across multiple exchanges, requiring sophisticated routing. 3. Concentrated ownership. Large holders, whales, can significantly impact order books. 4. Flash crashes. Cascading liquidations can temporarily eliminate liquidity entirely. 5. Withdrawal, deposit delays, exchange inflows, outflows create settlement frictions. Liquidity distribution across the market follows a power law distribution. Bitcoin and Ethereum account for approximately 60–70% of total market liquidity. The next 20 assets might represent another 25%. Thousands of smaller assets compete for the remaining liquidity. The development of market-making infrastructure has substantially improved liquidity conditions. Professional market makers provide consistent quotes across venues. Algorithmic strategies ensure pricing efficiency. Flash crash frequency has decreased as markets have matured. However, liquidity remains significantly lower than in traditional financial markets. The impact cost of a $10 million Bitcoin trade remains 5 to 10 times higher than an equivalent notional trade in major forex pairs. Trading volume relative to market capitalization is generally higher than for traditional assets, indicating more speculative activity. Liquidity can evaporate rapidly during market stress, as traders withdraw to sidelines. Understanding liquidity dynamics is essential for both trading strategy development and risk management in cryptocurrency markets. 3.4 Market participants and their influence. The cryptocurrency ecosystem encompasses diverse participants with varying motivations, behaviors, and market impact. Retail investors, individual market participants, represent the majority of market accounts but a minority of trading volume. Can be categorized as speculators, short-term price movement focused; hodlers, long-term believers practicing buy and hold; users, primarily interested in utility rather than investment returns; traders, technically focused participants seeking arbitrage or momentum, often susceptible to narrative shifts and market sentiment. Collectively can create significant market movements during periods of retail enthusiasm. Institutional investors, professional investment entities, corporate treasuries, MicroStrategy, Tesla, traditional asset managers, Fidelity, BlackRock, cryptocurrency-focused funds, Grayscale, Bitwise, venture capital firms, A16Z, Paradigm, family offices and high net worth individuals. Typically employ rigorous risk management and position sizing. Often focus on Bitcoin and Ethereum as gateway assets. Increasing institutionalization has contributed to reducing market volatility. Market makers and liquidity providers. Professional trading firms, jump trading, Wintermute, GSR. Algorithmic strategies providing bid-ask quotes. Arbitrageurs equalizing prices across venues. DEX liquidity providers earning trading fees. Essential for market efficiency and price discovery. Typically remain market neutral but can amplify moves during extreme conditions. Miners and validators. Secure proof of work networks through computational power. Stake assets to validate proof of stake networks. Face ongoing capital expenditure and operational costs. Often maintain large cryptocurrency holdings. May exert market pressure when converting rewards to fiat. Mining pools concentrate influence in proof of work systems. Large validators wield significant governance power in proof of stake systems. Protocol developers and foundations. Core teams developing underlying blockchain technology. Often hold substantial allocations from Genesis blocks or pre-mines. Treasury management decisions can impact market supply. Governance proposals may affect tokenomics and value accrual. Development roadmaps influence investor sentiment and adoption expectations. Decentralized autonomous organizations, DAOs. Community-governed entities controlling protocol parameters. May manage substantial treasury assets. Voting decisions can directly impact token utility and value. Variable governance participation creates concentration risks. Regulators and policy makers. Securities regulators, SEC, ESMA. Banking and financial conduct authorities. Tax authorities and enforcement agencies. Legislative bodies establishing legal frameworks. Regulatory announcements frequently trigger significant market movements. Compliance requirements influence exchange listings and institutional participation. The relative influence of these participants fluctuates across market cycles. Early bull markets often begin with institutional accumulation. Mid-cycle expansion typically sees increasing retail participation. Late-cycle euphoria may feature widespread speculation and FOMO. Bear markets tend to be dominated by long-term holders and value investors. Understanding participant behavior patterns provides context for price movements and helps forecast potential market reactions to new developments. Chapter 4. Key market participants. 4.1 Retail investors, behavior patterns and market impact. Retail investors constitute the most numerous participant group in cryptocurrency markets, though the collective market impact varies substantially across different market phases. Understanding retail investor behavior requires examining several key aspects. Demographic and geographic distribution. Initially dominated by tech-savvy males in North America and Europe. Gradually expanding to broader demographics and emerging markets. Particularly strong adoption in regions with currency instability or limited banking access. Notable concentration in South Korea, Japan, Nigeria, Vietnam, and the Philippines. Age distribution skews younger than traditional financial markets. Behavioral characteristics. Higher risk tolerance than typical retail investors in traditional markets. Greater willingness to self-custody assets. More engagement with community and governance. Susceptibility to social influence and narrative-driven investing. Tendency toward momentum trading and trend following. Investment approaches. Dollar cost averaging. Regular purchases regardless of price. HODL strategy. Long-term holding despite volatility. Momentum trading. Following short-term price trends. News trading. Reacting to market announcements. Yield farming. Seeking returns from staking and DeFi protocols. Narrative investing. Allocating based on thematic trends. Market impact patterns. Most pronounced during weekends when institutional trading volume decreases. Amplification of market movements during extreme sentiment shifts. Creation of support, resistance levels around psychological price points. Influence on smaller cap assets disproportionate to overall market impact. Potential to create short squeeze scenarios during liquidation cascades. Retail investor sentiment can be measured through various indicators. Exchange inflow, outflow ratios. Social media sentiment analysis. Funding rates in perpetual futures markets. Google Trends search volume for key terms. New wallet creation metrics. App download statistics for major exchanges. The retail market segment has evolved through several phases. 1. Early adopters, 2009-2013, tech enthusiasts and libertarian-minded individuals. 2. Speculative phase, 2014-2016, expansion to day traders and risk-seeking investors. 3. Mainstream awareness, 2017-2018, broad public participation during eco-boom. 4. Consolidation, 2019-2020, core community remaining through bear market. 5. Expansion phase, 2021-present, new user influx driven by institutional validation. Understanding retail investor psychology and behavior provides valuable context for market movements and can help identify potential inflection points in market cycles. 4.2 Institutional market participation. Institutional involvement in cryptocurrency markets has transformed from virtually non-existent to increasingly mainstream, significantly impacting market structure, liquidity, and legitimacy. This evolution has progressed through several distinct phases. Early resistance phase, 2009-2016. Limited to crypto-focused venture capital, Pantera, digital currency group. Traditional institutions largely dismissed cryptocurrency as speculative or fraudulent. Absence of regulated custody solutions prevented fiduciary participation. Lack of compliance frameworks and regulatory clarity created legal uncertainty. Initial exploration phase, 2017-2019. Introduction of CME Bitcoin futures, December 2017. Development of qualified custodial solutions, Coinbase Custody, Fidelity Digital Assets. Formation of crypto-specific trading desks at established firms. Emergence of institutional-grade market data and analytics. Integration phase, 2020-2023. Corporate treasury adoption, MicroStrategy, Square, Tesla. Entrance of traditional asset managers, Paul Tudor Jones, Stanley Druckenmiller. Development of prime brokerage services. Launch of institutional-focused derivatives products. Expansion beyond Bitcoin to Ethereum and selected altcoins. Mainstream adoption phase, 2023-present. Regulated ETF products gaining approval. Integration with traditional banking infrastructure. Established financial institutions offering crypto products to clients. Development of institutional DeFi access points. Different institutional segments have distinct engagement patterns. Asset managers. Primarily focused on Bitcoin and Ethereum as portfolio diversifiers. Typically allocate 0.55% of portfolios to digital assets. Often choose regulated vehicles for exposure. Emphasize regulatory compliance and custody security. Examples: Fidelity, Vinek, ARK Invest. Hedge funds. More active trading approach versus long-only managers. Utilize arbitrage opportunities across venues. Deploy quantitative strategies based on market inefficiencies. May take directional positions based on market outlook. Examples: Pantera Capital, Polychain Capital, Brevan Howard Digital. Corporate treasuries. Typically focus on Bitcoin as inflation hedge or reserve asset. Usually employ longer time horizons. Generally avoid lending or yield generation. Often publicly announce positions for shareholder communication. Examples: MicroStrategy, Block Inc., Tesla. Venture capital. Early stage investment in protocols and infrastructure. Often receive token allocations with vesting schedules. Provide advisory services and governance participation. Long-term investment horizon with defined exit strategies. Examples: A16Z Crypto, Paradigm, Multicoin Capital. Family offices. Highly variable approach depending on principal preferences. Often more willing to explore emerging opportunities. Typically longer investment horizons than hedge funds. Less regulatory constraint than registered investment advisors. Examples: Horizon Capital, Soros Fund Management. Institutional influence has reshaped cryptocurrency markets in several ways. 1. Increased liquidity. Professional trading enhances depth and reduces spreads. 2. Reduced volatility. Larger, more stable capital bases with longer time horizons. 3. Improved infrastructure. Demand for institutional-grade services drives development. 4. Regulatory development. Institutional pressure accelerates regulatory clarity. 5. Market segmentation. Creation of institutional-grade assets versus broader market. Institutional participation metrics can be tracked through Grayscale Trust Premium Discount, CME Futures Open Interest and Volume, Corporate Treasury Announcements, Regulated Fund Inflows, Large Block Trade Frequency, Institutional Custody Solution Assets Under Management. The trajectory of institutional adoption suggests continuing integration of cryptocurrency into traditional financial systems, though with significant regional variations based on regulatory environments. 4.3 Mining economics and market influence. Cryptocurrency mining represents a unique market force that bridges industrial operations with financial markets. The economics of mining creates distinctive supply-side pressures and market dynamics. Mining business models and operational structures. Vertical integration, companies controlling every aspect from chip design to energy generation. Specialized operations, focusing exclusively on mining operations. Diversified digital asset companies, mining as one business segment among others. Cloud mining, selling hash power to customers without direct hardware ownership. Proprietary mining, self-mining with owned equipment and facilities. Major operational considerations include capital expenditure, hardware purchase, facility construction, infrastructure development. Operational expenditure, electricity costs, staffing, maintenance, security. Geographic considerations, energy pricing, regulatory environment, climate cooling needs. Hardware lifecycle, depreciation schedules, upgrade cycles, secondary market value. Mining economics and profitability drivers. Hash price, revenue generated per unit of hash power, typically measured in $TH per day. Network difficulty, adjusts based on total network hash rate. Electricity costs, primary ongoing operational expense, typically $0.03 minus $0.07 per kilowatt-hour for competitive operations. Hardware efficiency, energy consumption per unit of hash power, with TH. Block rewards, base issuance plus transaction fees. The profitability threshold, break-even, can be calculated as break-even price equals operational costs, expected mining rewards. For Bitcoin, this creates a dynamic support level that fluctuates based on network difficulty and mining efficiency. Market impact patterns. Compulsory selling. Miners must regularly liquidate portions of mined rewards to cover operational costs. Hodling behavior. During bullish periods, miners may retain larger portions of rewards. Capitulation events. Price drops below break-even may force inefficient miners to sell assets and/or shut down. Difficulty adjustment mechanism. Creates feedback loop between price, profitability, and network security. Halving cycles. Periodic reduction in block rewards creates supply shocks. Major publicly traded mining companies often serve as proxies for leveraged exposure to underlying cryptocurrencies. Their stock prices typically demonstrate high correlation with cryptocurrency prices but with amplified volatility due to operational leverage. Proof of stake dynamics. The transition of major networks like Ethereum to proof of stake has created different economic pressures. Validators receive rewards proportional to staked assets rather than computational power. Economic security derives from asset value at risk rather than hardware investment. Slashing penalties replace energy costs as the primary economic disincentive for misbehavior. Staking removes circulating supply, potentially creating upward price pressure. Liquid staking derivatives allow participants to maintain capital efficiency while securing the network. Mining pools and centralization concerns. Mining pools consolidate hash power from multiple participants, creating potential centralization risks. Major pools can potentially influence transaction inclusion or censorship. Pool concentration in specific geographies creates jurisdictional vulnerability. Protocol development may be influenced by dominant mining interests. Pools compete through fee structures, payout methods, and auxiliary services. Understanding mining economics provides insight into structural support levels, potential capitulation points, and supply dynamics that influence broader market behavior. 4.4 Decentralized governance and protocol politics. The governance mechanisms of cryptocurrency protocols create unique market dynamics where stakeholder voting, development decisions, and community sentiment directly influence asset valuation. Understanding these governance systems is essential for comprehensive market analysis. Governance models and structures. Off-chain governance, informal consensus among core developers and community, Bitcoin. On-chain governance, formalized voting mechanisms using tokens, Tezos, Polkadot. Hybrid systems, combining off-chain discussion with on-chain execution, Ethereum. Delegated governance, representative systems where stakeholders elect decision-makers, EOS. DAO structures, fully decentralized organizations governed by smart contracts and token voting. Decision-making processes. Improvement proposals, formalized suggestions for protocol changes, BIPs, EIPs, AIPs. Request for comments, RFC, open discussion period for proposal refinement. Signaling votes, non-binding indications of stakeholder preferences. Formal governance votes, binding decisions that may trigger automatic implementation. Rough consensus, informal agreement among core stakeholders without formal voting. Governance participation patterns. Core developers, primary architects of protocol improvements. Token holders, voting based on economic stake in the system. Miners, validators, influence through implementation decisions and fork support. Protocol foundations, stewardship organizations managing development funding. Large stakeholders, significant holders with outsized influence, whales. Community contributors, non-technical participants providing feedback and advocacy. Governance mechanisms market impact. Token value correlation, strong governance rights often correlate with value capture. Fork risk premium, contentious governance increases uncertainty discount. Development velocity, governance efficiency influences competitive positioning. Community strength, active governance participation indicates strong fundamentals. Regulatory considerations, governance centralization may trigger securities designation. Governance challenges and evolutionary trends. Voter apathy, low participation rates in most governance systems. Plutocracy concerns, voting power concentration among large stakeholders. Delegate systems, emergence of specialized governance participants. Quadratic voting, experiments with nonlinear voting power to reduce plutocracy. Multi-chain governance, cross-chain coordination for interoperable protocols. Conviction voting, time-weighted voting systems favoring long-term stakeholders. Holographic consensus, combining prediction markets with governance. Case studies in protocol governance. Bitcoin, conservative minimalist approach with high consensus requirements. Ethereum, community-led evolution with developer-heavy influence. Uniswap, token-based governance with significant foundation guidance. MakerDAO, complex multi-stakeholder system with specialized roles. Tezos, self-amending ledger with formal on-chain amendment process. The governance systems of cryptocurrency protocols represent novel experiments in digital coordination. Their evolution continues to influence both technological development and market dynamics, creating feedback loops between governance mechanisms, protocol functionality, and asset valuation. Understanding governance structures provides insight into long-term protocol sustainability, adaptability to changing conditions, and potential for value accrual to token holders, all critical factors for fundamental market analysis. Commodity, crypto. Swing trading is a short-term strategy that seeks to profit on swings in the value of a stock, commodity, crypto, or the Market itself if you are trading index funds. While the phrase short term is used, this is only relative to long term investors with time horizons of years to decades. A swing trader is not a day trader and instead looks to profit from changes in market price that occur over days, weeks, and even months. If you are looking to buy a stock and sell it in 6 to 8 months for a profit, you're a swing trader. If you're looking to buy a stock today and sell it in 3 to 4 days, you're also a swing trader. A swing trader isn't out to make day trades. As we will see, it is important to distinguish swing trading from day trading for legal reasons. There are multiple strategies that can be used to both predict market swings and to hedge your bets, that is mitigated or minimize losses. You can swing trade on any market or with any type of asset, including forex, gold, or bonds, but most swing traders focus on the stock market. What is day trading? Day trading is considered a high-risk activity and so is heavily regulated. To become a day trader, you must have at least $25,000 cash in your account, and many experts recommend that you have $30,000. Brokerages will strictly monitor who is a day trader and who is not. You can receive a day trading designation by engaging in at least 4-day trades in any 5-day period. To count as a day trade, you must buy or sell the same security more than once on the same day. It's important to understand the rules if you are trading options. You can buy and sell multiple options contracts on the same day without getting the day trade designation if you are trading different contracts. So, if you buy and sell shares of Apple on the same day, that counts as a day trade. But if you buy an options contract on Apple, sell it and buy a different options contract on Apple later in the same day, even though you've made 3 trades, that does not count for even one day trade. Day trades carry over the weekend. So if you make your first day trade on Friday, and make a second day trade the following Monday, your day trade count will be 2. If you make 2 more trades by Thursday, then you're going to be designated as a day trader and have restrictions placed on your trading account. There are some brokerages that don't have the capital requirement, but they take huge commissions. These brokerages are not used by professional day traders but can be used by small investors to learn the art and science of day trading, without having to put up $25,000. Even with the high commissions, if you are good at it, you can make profits. Day trading relies on several strategies to anticipate moves in the markets. These include various signals that indicate whether a given security is going to increase or decrease in price. If the signal indicates a price increase, that can be a good time to buy. If the signal indicates a coming downturn, that can be a signal to sell your shares. Professional traders don't rely on one signal, they take into account multiple signals to make reasonable bets. Often, the bets will be wrong, and you'll face losses, but people who are skilled day traders are right more often than they are wrong and make substantial profits. Swing trading versus day trading. Swing trading is kind of a version of day trading light. With swing trading, rather than looking to make a profit on moves in a security that occur in 1 day or less, you're looking to profit on price fluctuations that occur over mid-term time frames. You can think of swing trading as occupying a middle ground in between day trading and conventional stock market investing. Time frames used in swing trading can be as short as 2 days, up to a few weeks, and even out to a few months. You are attempting to capitalize on large moves or swings in the market rather than on short-term moves that a day trader focuses on. One important distinction is that swing trading is not something that is regulated. There aren't capital requirements placed on swing traders. The only capital that you will need in your account is enough to do the trades that you want to carry out, so you can start small and not Worry about putting $25,000 in your account. As far as the brokerage is concerned, if you are not carrying out day trades, you're just another investor. Since you're not trying to profit on the heat of the moment. Changes in the direction of a security during a single day. Swing trading has a lower risk than day trading. However, the upside is the same. You can profit quite handsomely doing swing trading, probably as much as you can doing day trading. It requires more patience than day trading since you might have to wait several days, or even weeks, or a month before potential profits are realized. Even so, swing traders use many of the same techniques that day traders use. In some of the analysis a swing trader uses, you will be looking at the same exact signals the day traders are looking at. The only difference will be the time frame of consideration and when you will act on your trades. While day trading can attract adrenaline junkies who are hoping for quick wins, swing trading is more suitable for a calm personality looking to build on investments. In both cases, you are hoping for short-term profits that are made off moves in the securities you invest in. And swing traders also rack up wins and losses. Many times, your trades will be based on assumptions that are simply wrong, and you'll lose money. However, with a less frantic pace, as a swing trader, you'll have more time to carefully consider your trades. Also, you'll have a longer time horizon to realize profits. This can reduce risk because although stocks can plummet fast, they can often recover value given enough time. That won't always happen, but you can see recoveries. There are no hard and fast rules. Unlike a day trade where you will want to exit quickly, you don't have to close your position on a swing trade over any defined time period. You can stay in the position for weeks or months. Whatever suits you. In summary, swing trading is an active form of trading in securities. It will let you take a very active role in the management of your account, and require that you follow financial, economic, and political news very closely to anticipate moves in the securities you are interested in. Also, like day trading, you're hoping to book profits in the near term, rather than buying and holding until you're in retirement. What instruments can you trade in with swing trading? The answer is basically anything that can be traded. The most frequently used traded securities include stocks, options, exchange-traded funds, forex, crypto, bonds, commodities, including gold, silver, and platinum. We will look at each of these in the book and see how to apply swing trading techniques to each particular instrument. Chapter 3, Market Signals. The bottom line with swing trading is that you're looking to profit from short-term price moves, but the phrase short-term is relative. It's short-term relative to the traditional investor. It may be the same as a day trader in some cases, but will typically be a longer time horizon relative to day traders. While you can swing trade with virtually any instrument, in this chapter we're going to look at market signals used to trade stocks because the same types of market signals used here can be used for virtually any type of investing. Market signals are basically signals that indicate when an upturn or downturn in the price of the security is going to be realized. These signals are not perfect and can never be perfect, because markets are chaotic systems, and they are dependent on the emotional states, desires, fears, and logic of thousands of different individuals. Often, people engage in herd behavior and react to the same news in the same way. You might say that the indicators work, most of the time, or at least more often than not, to increase the probabilities that a trade based on a given market signal is right. Experienced traders rely on the evaluation of multiple indicators, rather than simply looking at one and declaring the stock is heading up or down and then engaging in the appropriate trade.